information on this webinar is general information and should not be viewed as applicable to your individual situation and/or circumstance. We recommend that if you have questions on your individual situation, that you follow up with either your attorney or specific accountant. Please also understand that the information we are providing is extremely fluid, is changing on a daily basis, and often getting superseded. What we present here today may very likely be irrelevant or incorrect tomorrow. As such, please know that it is only accurate as of today, certainly not going forward, and that even as of today, the information is only our best understanding based on how we have reviewed or interpreted the information.
Well, hello there. Thank you for joining us again for this week's webinar. We're titled it Bringing Business Back, which is a kind of a exciting opportunity here to be talking about that. It feels like the last several sessions that we've had has been more of the downward focus and more of the precautionary, and we'll certainly have that in today's webinar. But as we look outside and we see the sun starting to shine and the weather getting warmer, I think we're also seeing a general change in mood and shift as we see businesses going back, whether they're being around the United States from the various lifts and the various stay-at-home orders are being lifted in various different stages. If you're here in Michigan, we've gotten recent information, some that have extended it, some that has allowed businesses like the construction and the real estate and a few others to go back here soon. And so we're optimistically excited about that opportunity, and but cautiously as accountants here, kind of seeing what that's going to mean and where does that shift, as we've been focusing the last couple weeks on the cautionary retraction and how do we switch that now and start building back up. And there's a lot that's going to come into that we're going to talk through today. That's going to be the later part of our session, and I'm calling it Bringing Business Back. I figured since we went with a PPP, we might as well just throw in a couple other triple named like BBB, and we'll even do maybe a CCC in there just for fun. But before we get to that, we're going to probably talk a little bit, or we are going to talk a little bit about just a general update that we're seeing on the CARES Act stimulus, and then just some common PPP question and answers that we're getting right now. We could definitely say that we are in a stage of where we're seeing the PPP loans being funded. On that, where that PPP is, if you recall, the first round of the PPP loans that closed almost a week and a half ago now, and we are seeing that those have almost entirely have been now funded, documented, and deposited into accounts. The round number 2, we are seeing of that, it was a $350 billion second set of stimulus for the PPP program. Of that, about $175 billion, and that's as of May 1st, has been issued out, and so probably more as of even today, where today's recording has been past that. But we are seeing a lot of those being funded as well, and so a lot of the calls and some of the questions I'm going to answer here today are ones that we're getting we've probably talked about them in the past, but now that it's here, the realism, okay, what is it? And it's okay, I got my funding, it's in my bank account, what now? So first and foremost, what I would mention, if you're in that spot, if you're in the place where, okay, I got my funding, what now? I would refer you back to some of the past webinars that we've had over the last 2 or 3 weeks. One of them that we did where Katie and Corinne walked through how do you actually record it within QuickBooks, what's the best practices for doing that recording, as well as last week's webinar where we talked about ways to maximize it. And so as we look through those, that might be something to really focus on as well. I'm going to hit a few question and answers here this week, and then I'm going to shift, again, going into more of the go forward look. We've also noticed that several of the EIDL or EIDL loans, which is the Economic Injury or Emergency Injury Disaster Loan, we are seeing those being funded as well. So look into your checking account. And you'll probably see some of those. We're noticing that the tagline or the memo line is being called IRS Treas 310 Tax Ref is oftentimes what most are seeing. I put that on the slide there for you to see that. It's usually coming in multiples of 1,000 or 2 or 3. It is the number of employees. Interesting enough, I have seen some of the rental entities come through. So that if you didn't have an employees, they're getting the $1,000. So watch for that. On those, keep in mind that those are just the initial amount that is coming to you. So watch your emails over the next week, 2-3 weeks that are coming through, and you're going to see the next phase of that. If you've gotten the PPP loan, there are things you have to consider about this EIDL loan. So give us a call if you want to walk through it. So that process isn't quite done yet. But though we are seeing those funds coming in, and so check your checking account for those. The stimulus checks that are going to the individuals mostly have been now processed out. We still have a lot of clients that are having issues and throughout America. Some are having issues on getting their information into the IRS if say you owed in the past and you don't have a checking account with them in place. We've noticing the Social Security, those that are relying on the Social Security to have your account, those are getting delayed here. Not delayed, but those are the later tail end of these funding rounds, and those we're seeing come through here now. And so you should be also seeing your refunds or your stimulus come through those as well. Keep in mind there that if it doesn't come, if you're still entitled to it, it will likely come at some point. In worst case, we can get it in the filing of the 2020 tax return. And so it's not that you lose it, it's just a timing. We obviously want to do our best to make sure you can get it sooner than later. And so if you're having questions with that, either give us a call or you can go to the website, the IRS website, and there's instructions there on what to do for giving them the information. Something that I noticed, well, I have not spent much time talking about this in the past, but I am seeing this now coming out as well. There was this hole in the stimulus dollars, which were going to college students. And if you remember, so for the individual stimulus, it was up to $1,200 per adult, and then up to $500 for dependents below 17. So there's this hole between 18 and 26 where they're not a dependent, or they're not filing their own return, so they're a dependent on your tax return, but they're in college. There's that hole there in the stimulus. Have those college students check with their universities. So what's really happening is the universities received funding themselves, who are then passing it on to the students. And so, for example, Michigan State, Michigan, Michigan Tech, they have all now pushed out over the last week their loan or their stimulus package to their students. And generally, to qualify, you have to have been a student prior to the event of COVID, and you have to have had economic impact. And so if you do have college students, and you may want to check on them just to make sure that if they're not home with you right now, and they're maybe in the dorms or wherever, that they are looking out for this. We are seeing that these are first come, first serve, and so it's definitely something that you're going to want to have your student definitely check into. I thought it'd be kind of fun to go through a couple of stats. I am an accountant after all, and so we do like numbers and statistics. And so just to kind of keep it light here a little bit, just to give you the first round stats. So this is the first tranche, if you will, of the payroll protection program. Just a couple numbers here. Estimated total loan applications were 7,148,178. Of those, they converted and made into approved loans of 1,662,367. So about 23.25% of those that applied for it actually have gotten it approved. You're definitely seeing a much higher approval rating on the second round, and that's why they had the second round, because of this fact that they had so many people, so many businesses apply, and only so many in the shortage that they saw. The average loan amount was $205,898, and that definitely trailed down toward the end. So the very larger ones were much sooner. Those are the ones that most of us have now seen in the media. The $10 million ones that hit out pretty early. And that implies and calculates out to an estimated yearly payroll for the average business of $1,338,337. And then you're going to see some shocking differences and glaring differences as we look into the second round or second tranche of the PPP. So statistics here are being presented. These numbers are coming straight from the SBA. And this is only for the period of April 27th through May 1st. So that's only a 4-day window there, and it's already May 5th. And so this is going pretty quick here. But you're going to see there on the screen, it's definitely now shifted from the average of what was the $205,000 average to where now, if you look at the loans under 50,000, there's 1,567,355 of the loans are under the $50,000. I mean, you can kind of see the spread there between 50 to 100 was 304,561, and those over 5 million was limited down to 1,472. And your average loan now is 79,000 as compared to the first round was 205,000. So definitely a shift from the larger entities, the middle-sized entities, to the smaller. So here again, it's a couple more stats. Total loan approvals of 2,211,791. I thought I'd throw a couple interesting statistics on Michigan. So of that, Michigan was 60,373 loans. So about 2.73% on a quantity over the U.S. The gross loan through that 4-day period was $175 billion. So it's about little over halfway through the process. And this again as of May 1st. And the Michigan loan amounts. So the Michigan amount was $5.57 billion or 3.17%. So shifting into this magic timeline, and if I can say that based on the number of calls we're getting, this is certainly the one that people are getting the most confused on, and also wanting to really maximize as we drive it home, and all the other websites and information out there. It's when we're trying to maximize this PPP loan forgiveness. There's a couple key dates in here, and so I'm presenting on this slide. Again, I'm not taking credit for this. Someone else created this slide, this that I'm using here, but I think it illustrates pretty closely what we're hitting on. There's a couple missteps, is what I'm going to call it, that we have to really watch for within that. And so some key dates that we see is the February 15th of 20 and the April 26th of 20. And why those have become key dates is when we're doing this look back period for the amount that can be forgiven, the amount of that loan that is forgiven is first off based on the amount that you actually pay during your 8-week period. And I think most people get that. But it's reduced based on if you have to have the same amount or keep the same amount of employees from a FTE or a full-time equivalent headcount, as well as a payment amount. And so this period from February 15th through April 26th is a key period because the measurement date you'll find is that February 15th. And then there's this period in between here that they allowed, and they know that employees and businesses probably are shifting and weren't thinking of necessarily the PPP and were just reacting. It's being commonly called the knee-jerk period. And you were just reacting. Now on that April 26th, they said, okay, by that point as a business, you probably are aware of everything that was coming on and the intent of pulling it back. And so they kind of have this forgiveness or grace period that's on the June 30th, and I'm going to get into these on details here. But the key note there is if you've, on that April 26th, that's a key date that is not oftentimes talked about, but you can't have any reduction in employees from April 26th forward. If you do, there's no oopses, that it truly is reducing down your forgivable amount. And so those are some key dates that we're going to want to watch. And I'm going to refer back to this slide here as we go through some of these missteps. That again, this is what I'm talking about frequently here over these next couple or these last couple days, as I'm hearing people say, okay, we got our funding. What do I have to worry about? What do I have to be cautious on? And so these missteps here that I want to hit on are, there's about 5 of them. There certainly are more, but I'm going to focus on 5 that we want to watch out for. And this, the first 2 are somewhat related, but it's that headcount reduction and the pay rate reduction. And so if you get, again, if we come into this here, if we step back, we have a loan that we received. Let's call that, for argument's sake and illustrative sake, $100,000 that we received as a PPP loan. That's the amount. Now, we don't have to have all of that forgiven. We don't have to spend all those dollars. We can use those and it ends up being a loan potentially. But I think our goal in most businesses is that we want to maximize what gets forgiven. And so if you let's for the sake here of $100,000. Now that $100,000, let's hypothetically say we spend all $100,000. And so one would argue that we can, on unallowable costs, we spend it on payroll and on other allowable costs. We would like to say, well, that means we're going to have $100,000 forgiven. That's not always the case. There's two reasons it's going to get reduced. One is if you reduce your headcount, and two is if you reduce the pay rate reduction. Okay, and so you got to look at there's two separate reductions here. Now, I'm going to surmise, I'm going to tell you that most of our clients, if we're working through this and you're thinking about this now, we're probably going to be able to avoid these reductions, but I want you to think through them to be aware and to watch for it. The first is the headcount reduction. So let's go back to the example where we had $100,000 that we got the loan for $100,000 and we spent all $100,000 on qualifying costs. And we're like, okay, I'm going to have it all forgiven. And we say, well, no, you know what? We had 10 FTEs or 10 full-time equivalents before, and now we only have 8. Your forgivable amount is reduced by that same percentage of what that you reduced your employee count. So in the example where I just said there, where we had 8 employees and before we had 10, so you had a 20% reduction because you only have 80% now. You would end up, you'd take your $100,000 times that 20% reduction gives you that your forgivable amount is only $80,000. We have to be very careful on this that we're going to be running into these. And this is as you start ramping back up and thinking about, okay, when do we hire people? Now, the key on this is going to get back into we don't want to miss the rehire and the pay cut remedy. And that comes back, if you'll note here on the slide, you've got this June 30 period. This FTE pay cut or this headcount reduction goes away if you've hired the employee back by June 30, and it's on an employee by employee basis. So you're going to come up with lots of detailed spreadsheets. We've got spreadsheets that you can use as we track these costs and track these scenarios to make sure. But it's by employee. So you've got Fred and Bob and Sue and Susie that you're going to go through and you're going to look at these and you're going to make sure that you didn't reduce those those head counts. If you hire that employee back by June 30th, so on the June 30th payroll, they're hired back, it's not counted as a head count reduction. Be careful here because I'm talking about a couple different reductions. There's the head count reduction, there's the pay rate reduction, and then there's the overall qualifying costs that you have to spend. And so know that I'm going to walk through here on making sure that we hire those people back potentially hire them back by June 30th. And then by doing that, we reduce and we don't get hit by the headcount reduction. But if you wait until the very end of the period to hire those employees back, you also have to remember you may not have that actual cost that you spent within a qualifying cost. And so these limitations are coming at about 3 or 4 different directions that you got to be very careful about. And then this is where I'm going to take the moment to step back, to breathe, and then also to say, you'll hear me repeatedly say, do what is right for your business and your individual circumstance for the business sake of things, not necessarily to maximize the incentive. Again, we want to do everything we can to maximize it, but the first and foremost thing that we have to do is if it doesn't make sense to pull back an employee, you may not want to do it. And that might mean that you leave some dollars on the table. Well, again, the detail accountant in me doesn't want to do that, but we have to be thinking about what's right for the business. And so phasing in employees might be the right thing, and I'm going to get to that later in the presentation. But I'm giving you steps in here on what we have to be careful about so that way we can maximize these incentives. But then I'm also in the same sentence telling us that we have to be cautious that we don't just hire people back or we don't just pay people a raise or other things just to get them back, because that might not be the right answer long term. Okay. Going back then into our common missteps, we talked a little bit about the head count reduction. And again, you'll note here on this slide, and I've presented, this was actually in the very first presentation we had, way back in March. There's a couple different periods that we can look at, whether it's the February 15th through June 30th of 19, whether it's the January 1st through February, what's the prior quarter. Most now are using the prior full quarter to compare it. So in general, what I would tell you is we should look at the January 1st through March 31st head count as well. And so we've got guidance on our website, and you can talk to the accountant, either Jeff, Katie, myself, or anyone else here. We can talk through your individual circumstance as to what is the denominator, if you will, in that calculation for your particular business that we're worried about, and which period do we want to use. So there's a lot of nuances and very detailed calculations in this calculation and in this process that we're going to want to think through. Again, we have a spreadsheet that we can pass on, or we're developing a spreadsheet that we're going to be able to pass on, that will be able to, you can kind of walk through some of these scenarios and document some of this as well and be thinking about it, because we want to be very careful that we're watching these missteps. So again, we've got the headcount reduction, we've got the pay rate reduction. So this is where early on in the process, we're like, well, you know what, as long as we get the pay out and we can bonus some of the key management, we should be good. Well, the SBA caught on to that pretty quick and said, no, they're going to limit it, and they're going to look at it employee by employee basis. So they're going to go back and they're going to look at the prior full quarter here, which is the January 1st through March 31st period of 2020, and they're going to compare what did Bob make during that period, what did Susie make during that period, and if you have more than a 25% reduction, you are going to get a reduction on your overall payroll or forgiveness. So there's two separate tests. There's the headcount reduction and the pay rate reduction. Again, having then said that, this is a kind of complicated thing as we walk through it. We've got these reductions that we have to watch out for, but assuming that you pull them back by June 30th, we're good. So coming again back to that June 30th, that's that magic day, that June 30th here. We can remedy both the headcount reduction as well as the pay rate. So if you've brought the employee back up to what they were making before, then you're also good. I'm actually seeing in practicality that the number one, the headcount reduction, is going to be probably a harder thing for us to hit than the number two, the pay rate. Most of the people we're talking to aren't seeing a decrease in wages per se, because they're ending up having to pay employees higher dollars to come back, whether it's through hazard pay bonuses or through otherwise, because people have gotten higher dollars when they're on unemployment. And so the pay rate is less of a trigger. It's there, we got to watch out for it, but we really have to watch that head count too. So two other ones that I see coming down the line that I want to hit pretty hard here, is the fourth item there, which is the 25%. So people in general have gotten the idea that says, okay, of my loan, 75% has to be payroll costs and 25% it can be non-payroll, which is the rent, interest, and then utilities and a few other things. What a lot of people miss is that 25% that's forgiven is a floating 25%. So it's not necessarily on your original loan, rather on the payroll amount that is forgiven. So let's go through an example of this. Using that same $100,000 loan that we got before. A lot of people are saying, well, as long as I spend $25,000 on rent and utilities, I'm good. And that's what's being forgiven. Well, not necessarily. So using that $100,000, let's say that $100,000 is reduced down to $80,000, either by a head count or a pay rate, or just because you don't spend it, because you haven't had the payroll. So you took out $100,000, you end up with $80,000 of total amount that's allowable. So you had a 20% reduction. Well, that 25% then is also reduced down as well. And so there only of that 80, only 20,000 can be inside of the rent and other costs. So it's not off the original loan, it's off the smaller amount that we have to be careful about. Again, we can walk through some examples on your individual case, and I definitely recommend that you know your numbers pretty well on this. And there's a lot of guidance on there specifically for yours, and so we should definitely be doing some PPP planning overall, and you know your numbers there. The last one I'm going to hit here is self-employed. So the self-employed calculation is based off your 2019 taxable Schedule C or partnership return. And what a lot of people don't understand is when you walk through this, and I'm calling it the self-employed catch, is just the way the calculation works. Most self-employed individuals are not going to get 100% forgiven. And here's why. So if you remember, let's use that same example, the $100,000, that your net income was $100,000 last year. And therefore, if you had $100,000 of net income, divide that by 12 times 2.5. I'm going to do this math because I'm not great at mental math here on the screen. So we're going to go 100,000 divided by 12 times 2.5. So in that case, your loan would have been $20,833. But you're noted, I did it 2.5 times. The forgivable amount now has been come out and has said it is 2 months of your, or 8 weeks of your, 8 weeks of your 2019 taxable. So there's a spread, that the difference between the 8 weeks and the 2.5 months. That spread there, if you have outside rent that you're paying someone, probably not going to be as big of an issue. But many self-employed individuals use their home office, and the utilities are items that are in their personal name, not in their business name. If that's the case, the likelihood that you as a self-employed individual are going to have the extra that extra 25%, if you will, or the difference between the 8 weeks and the 2.5 is pretty small, that you're going to be able to spend those extra dollars. And so again, you should go into it knowing that there's a good chance that if you're self-employed, you're not going to qualify for 100% of it being forgiven. Again, what I stress here is if you are self-employed and you have these calculations, use those estimators and those calculators that we've got out there to walk through and know your numbers as to what you think you're going to have forgiven, and you can make the determination of whether you want to forgive it or have a forgivable loan, or a non-forgivable loan, or if you're going to give it back, or what you're going to do in those scenarios. So again, the biggest takeaway that you should have on these, all of these missteps are likely avoidable as long as you think and plan ahead, and we can certainly help you through that process overall. Okay. Shifting gears, almost a 180 here again. I was focusing on just the PPP, but as it comes through and where this is going to play into it is coming through and trying to decide, business is starting. We're bringing business back, and it's coming back. What does that look like, and how does that play into both the forgivable loan within the PPP, or maybe you had the employee retention credit? Maybe your particular case has it that you've continued business all the way along. You've been deemed essential workforce. Or maybe you're in the case where you're a restaurant and you've had some employees that have been able to help on the carry out, but not others. What does it look like to come back? And there's a lot that's going to be nuanced here. And this is that second round. And you're going to note on this graphic here, again, I've kind of dubbed this. We've got the PPP, so the Payroll Protection Program. Now we're calling it Bringing Business Back, or the BBB. And I'm using a schedule here that's the CCC. So the cash flow, CARES Act, and communication. I think these are three crucial things as a business owner that we should be looking at in order for this ramp back up, and the 3 C's for business survival, if you will. So you'll note the CARES Act. That CARES Act is what we just got done talking about, is the PPP program. It's the funding, it's the stimulus, it's the employee tax credit. It's all these different incentives. It's only a small part. It's a key part, but it's only part of the overall picture as we come back. One other big picture is communication. And I've stressed on this before, and I think it goes without saying, if you will, of what's inside of there, but communication with your advisors, with your customers, with your vendors, with all of those across the board is absolutely critical as you come through and ramping back up. I'm not going to spend a ton of time talking on that, but that's something that you should focus on absolutely, is the communication. And the third one here that I'm going to talk about to have really a successful comeback and bringing business back is on that cash flow. And that's where, as we look through here, you're going to note the CARES Act certainly plays a very big part of that. It sustained us through this downturn, and it's given us this cash flow as we come forward. But as you've heard me say in the past, expenses go out much faster than what the revenue comes in, and especially as you're seeing a ramp back up in business, because most accounts receivable and most AR, if you will, and revenue doesn't come in faster. It usually comes in slower than what bills go out. And so it's going to be something that many businesses are going to be dealing with here for quite some time here as we look through. So as we do that, I want to take an opportunity here to kind of hit a couple different things for cash flow, and that I would like us all thinking through in these coming weeks. The first one is that we've got to really manage our supply chain risk. And that's fancy words for saying, as you ramp back up, you're not alone in business. You've got to look at what's coming beforehand. So if you look down and just because you want to start tomorrow doesn't mean that your key vendors that are providing you information are starting tomorrow as well. And so if you are, here's the perfect example. We're going to go to the big scale. If you're Ford or GM, you can't just start tomorrow because you have to have the tier 1 start before GM does. But before the tier 1s can start, the tier 2s have to start. And before the tier 2s start, the tier 3s have to start. So there's a trickle down effect there, that supply chain. And while I use the example of Ford, and we oftentimes like to, we point, well, we're a small business, and that's the big guys. That's not the case. As you look at it, if you're a flooring company that's going to be installing floors, well, you have to make sure that the stock of that floor is already started and coming back before you can go to install that floor. If you're a painter that wants to start on Monday, well, you have to be able to go buy that paint. Or, as you walk through, so you have to think ahead to really pull things back in time and allow your time, your process here for that time and that supply chain to get built back up. And that's going to impact your ability to turn around and do work, which is going to impact your ability to get the revenue related from it. So assess where your supply chain is and whatever size of business you are, if you're a restaurant, being able to get the food all across the board, make sure you sit down and say, okay, what is my supply chain risk and what do I need to do? For some businesses, it might mean that you're going to have to take a stake in some of those smaller supply chains to get it going, or that when I say take a stake, you might have phone calls with them or talk with them. It may be all the way of buying them. Probably not, but it could be. But it may be having direct calls of understanding where are they at and what are they doing. Next, we're going to go. Number 2 is we're going to revisit our variable costs. So variable costs are the ones that go up and down as our revenue. So if our revenue goes up, our variable cost goes up. If our revenue goes down, our variable costs go down. In theory, this is something that you as a business owner probably should have done already. And if you're just evaluating it now, it's probably a little bit too late because we should have seen those costs come down. Those are the ones now that you've hopefully already mitigated, but we should still be evaluating it again. So those are going to be the utility costs, the insurance costs. That okay, if in theory, if you're a baker and you got to heat the oven, in theory, if you're not heating the oven as much, then the electricity bill should go down. That's the variable cost, or the cost of your flour or your input should go down as well. So just know your costs there and figure out where it is that you can, really stop the bleeding there. Then conversely, with the variable costs, you have fixed costs. And what our goal here as we're looking to ramp back up is to say, how can we make those fixed costs become more variable costs? And so that we want to lower some of those fixed costs. That's a harder thing to do, but it's something that you may really want to evaluate and see if we can do that. And then the fourth one here, and this is going to really where I'm going to focus on for the next little bit here, is it's a shift in moving more into the cash to cash conversion cycle. And again, that's a lot of fancy words for basically saying when things are going well, we oftentimes focus on the profit and loss, the P&L statement. We look at, okay, how much did we make? What's my end number? And we focus less on cash and less on the balance sheet. Well, during a downturn and then a repick back up, really understanding the balance sheet and understanding your cash flow is absolutely critical. The P&L is going to come, but to a lesser extent. It's really understanding the timing on your accounts receivable and then the timing on your accounts payable and inventory, and really taking a stock and assessment of what's there. So on that, let's shift to that. So looking at your accounts payable and your accounts receivable. So those balances might have been sitting there for a while, and you might not have looked at it. We tend to harp every time we get in and do a quarterly or an annual accounting. Are these balances good? But really diving in now and taking this time to say, okay, do these customers really owe me, and can I collect on those, and should I be collecting on them, and calling them and talking with them? That gets to that communication. The same for the payables. Are the payables that I have on the books real payables? Do I really owe them? Or are these fictitious, and should I, clean this up a little bit? So taking the time right now to look at the accounts payable and the accounts receivable. I cringe a little bit on this one as the business owner that says extends payable intelligently. But it's something we should look at and evaluate. Do we want to push off paying payables? Again, that in theory should have been something that we've already done. But in practicality, there is businesses that are kind of floating through this process. And is this ramp up that's going to be the harder part. That as we start building these purchases back up, so say buying the lumber or buying the supplies or buying the raw materials, the steel, or the services that we have to have these, what can we shift off a little bit longer? Again, I don't play that game if it's just to play the game, but something to really look at and have open discussions with them. Because again, we want to manage and expedite the receivables. We talk about potentially extending out the payables, but only to the extent that the receivables got pushed out. Because this is the biggest thing that I can say is you've got to be realistic about when your customers are going to be paying you. Because they might be in a similar situation as well as what you are, and they might not be able to pay. Some may, but you got to be realistic about when it's going to be coming back. Even more so today than it was a month ago. And then more so, I would argue, potentially in a month, because this is where people are really going to be constrained in this next month where they're seeing costs go out to start their business. Are they then going to be able to pay you as well? And so really maintaining and staying on top of those accounts receivables and accounts payables right now is absolutely critical. You may look at considering alternative financing options. So where this is getting into is where do you want to factor or sell your accounts receivable, get loans against your accounts receivable? That I cringe a little bit on as well, but it might be a realistic thing that we have to evaluate, especially right now when we're seeing the receivables get pushed out. There is a little concern there, but it is something that you should look at. Kind of shifting, so we just focused on the accounts receivable. Now let's look at another one, which is fixed assets or capital investments. So we went into this year prior to the COVID-19 saying, okay, here's our budget for what we're going to be spending. Maybe we're going to buy some computers. We're going to buy a new bulldozer. We're going to buy a new tractor. We're going to buy something. Really reevaluate that. Does now make the most sense? It may, actually, because there might be some great purchases out there, and it might make sense to take advantage of these. But it might not as well. If we don't have that cash flow, maybe we need to be stepping back and saying, well, it would have been nice to buy that truck, but now we're not going to. Or nice to buy that machine, but now we don't have the funds to do it, and so we want to wait. Or you may choose to do it because now you're going to get a overall better price. So evaluate and reevaluate the investment options, or those capital investments. And then lastly, within the balance sheet, is we really want to focus on our inventory management. Don't go out and buy a bunch of equipment. I know it's hard or a bunch of inventory. It's hard right now not to stockpile because that's just the caution of what people are doing. And again, you might have already done it where you just inherently just spent cash to buy inventory to have it on hand. If we need to because of that supply chain, well, then we need to. But I caution, and we don't necessarily want to just jump out and do that where we have to start stockpiling a lot of this inventory. So inventory takes cash, and so we want to take a stock of what we have in inventory and really assess, do we need it in inventory? Can we reuse up some of this older things and take advantage of the slower time right now to use some of this and clean up our old inventory as well? And maybe you're considering doing some sales on some of the older inventory because people might like the fact that they can have a cheaper option, maybe a tier 2 or a tier 3 grade, like in quality of inventory that they might be okay taking right now because they would appreciate having the lower quality just because of the less dollar. And overall, it might be okay. So taking advantage of that is something that's important. And then the last two items here, as we look at the cash flow, are getting, what I'm seeing is, especially in Northern Michigan here and in business owners are doing a fantastic job on, is considering alternative and non-traditional revenue streams. So restaurant owners, partly because they're forced to, but in practicality is they're shifting to the takeout meals and the to-go meals and the dinner in a boxes. I mean, that's fantastic alternative, something that they probably wouldn't have been thinking about before this, but now are. Or you're a retailer and you're thinking about the subscription-based model, that might be something to think about. And it's not completely out of your wheelhouse, but it's something that you may not have been thinking about that's going to really bolster things that you can do in this time, that's going to bolster that revenue stream up and get it something that's faster and easier during this shutdown period. I see businesses all across the board doing this. Doctors' offices doing the remote sessions. Accountants, for us, for that matter, doing these videos and doing Zoom meetings. I think businesses have done a fantastic job on this. But now, how do we convert that into the revenue stream that you may not have otherwise done? I think it's going to be something that's important to look at. And then think beyond just your business. Think beyond your comfort zone. In a time period where cash is tight, it's tough to think about what your core, outside of your core. And one piece of advice would say you shouldn't be focusing out of your core, and you got to really evaluate this. But now also might be the time to take advantage of pushing yourself outside of your four walls and saying, what is it we can do to do more remotely, or to do things that outside of our comfort zone that really pushes us into getting alternative revenue streams that we might not have otherwise thought about, that are outside of just the core competency. So with that, we have had a couple questions that have come in over the session here, a couple that I had prepped a little bit beforehand, and then a couple that have come in. So I want to take this chance to answer a couple of those questions. But before I get to those questions, I just want to kind of circle back again and come back to this and saying, as businesses are coming back, as this revenue and this process is coming back, it's a three-part section. It's the stimulus dollars, and we want to maximize the stimulus dollars to the extent we can, but making sure that we're not just making businesses solely to maximize the stimulus. There is more than just that. To the extent that we can, we want to do it, but we also want to factor in cash flow and realistic business purposes, and as well as the communication overall, to truly maximize being able to make it through this period. And I can't stress enough the importance of calling, and I'm giving general advice here, just in general of what we're seeing on calls and people are asking, but call us and let's talk through and make an individual plan. Just like we stress on making tax plans normally, and we're definitely going to have a lot of opportunities for tax planning as well this year, and it's going to be crucial that we do tax planning for many, many fronts, on the downside and on the upside. But equally as crucial is doing this planning for this PPP and for these other incentives to make sure that you're really both maximizing what you can, but also stepping back and saying, do we want to do these? Because if you wait to think through these, it's probably going to be missed opportunity. A couple Q&As here that I wanted to go through that I saw was the following here. My company previously laid off an employee, but later offered to rehire the employee. If the employee declined the rehire, will my PPP loan forgiveness amount still be reduced? So that's getting into the head count and labor count that I was talking about earlier. And this is going in, diving in specifically into that question of saying, well, what if I tried to hire someone back, but they said no? The most common reason that we're seeing right now is that they're making more on unemployment than coming back. So the SBA has issued specific guidance and made it very clear that as long as the company made a good faith written offer to rehire at the same salary and wages for the same number of hours, the employee's rejection of that offer will not result in a reduction of the company's loan forgiveness amount. The company must document the employee's rejection of the offer. So documentation there is key. And then, so you must document it, but just know that if you make a good faith effort to call them back and they choose not to come back, that's not going to penalize you. So documentation is absolutely crucial in this. You should also note that the employee who rejects is likely going to have an impact of forfeiting their unemployment compensation as well. And so as a business owner, that may be good, that may be bad, but that is something to consider inside of there. And then a couple other ones. Can I have employees on unemployment and still get PPP? The answer is yes to that. So I've had a lot of people ask, well, I thought you said that you can't have unemployment and PPP. Well, the broad comment here is that you can have some employees on unemployment and some called back. The key is you can't have an employee on payroll and unemployment without them being affected. So if you're paying someone, so in order to have it qualify for the PPP proceeds, you're paying payroll. So you're paying them dollars. Those dollars then impact what that end employee can make on unemployment. So whether if they're on a reduced work schedule, if they're on full unemployment, that wage is going to impact that unemployment. So the theory when we say you can't have them on both, what you're getting to there is you can't have them on both and not have them be impacted. But you can, and you are allowed to have some employees on unemployment, some not. You can have that intermix inside of there. Any new guidance on the incurred and paid since last week? And we are continuing to see guidance, but the general gist is they are still holding to that incurred and paid. So that's going to take a lot of stress and a lot of planning there towards the end of that this 8-week period to make sure that we're truly getting the incurred and paid. And then the last one here is the forgiveness an all or nothing? So meaning if I don't meet the headcount requirement, or if I have a wage reduction, or if I don't spend all my dollars, is an all or nothing? And the answer is a flat out no. It is not an all or nothing. So it's a percentage reduction. So it's not like if you had 40 employees before and you come to 39, it's not that you miss all of the forgiveness. It's just a small reduction in that case. It's definitely not something that you have to worry about just flat out missing overall. So thank you again for participating in today's webinar. We appreciate you coming and paying attention and going through and making it this far through the presentation. Know that we're here to help. We definitely want you to give us a call to talk through on your individual case and basis and to do some planning here. Many of you we have talked through, and we've appreciated the ability to work through with your particular case. Let's keep that communication open. We definitely welcome that and enjoy the opportunity to work through together. We are going to continue to have these seminars coming on Tuesdays at 1 p.m. They're available on our website, so if you do miss this time, you can get them both on YouTube as well as our website. Do refer back to them because I'm trying not to duplicate the information we're talking about. So some of the questions that you may be thinking about and hitting on today, we might have presented in a prior webinar, so definitely recommend going out and getting those and seeing those. We're going to continue to be doing some other seminars and webinars as well. Probably not as much of the live stream and more of just available for you throughout this process. So check on our website, entrustcpa.us and integratedpayroll.us, Facebook, YouTube, all those fun things that are out there. So thank you again for attending, and wish you a great day.